evening, everyone. It is an absolute pleasure to be here tonight with all of you amongst a remarkable lineup of companies and speakers. Before diving into the presentation about Skeena, I'd like to share a little bit about myself. For nearly 20 years, I've been entirely focused on the mining sector in terms of my career and in terms of my investments. I've invested my own capital, I've invested my family's capital, and along the way, I have admittedly forgot about the importance of diversification. This intense focus on mining has given me a very deep understanding of what makes a solid investment opportunity possible. So when the time came to join Skeena about 1 year ago, I knew immediately this was something different. In all my years of investing, I've never seen this incredible combination of tier one attributes, rare attributes, all put together in one investment vehicle that I can say without hesitation, this is one of the best opportunities to generate significant investor return per unit of risk. And so the heart of my presentation will walk you through 8 key reasons why I believe this is the best gold and silver investment vehicle available today in the market. But firstly, I will be making forward-looking statements, so you are duly cautioned. A couple of slides on background just to set the stage. So Skeena's flagship asset is called Eskay Creek. We are focused on advancing one core asset. If you're not familiar with the history of Eskay Creek, it is phenomenal. It is a past-producing underground mine that was previously owned and operated by Barrick until 2008. In the world of geology and academia, many students around the world study Eskay Creek on their thesis because this deposit, this ore body, was the highest grade gold mine in the entire world. The ore was so rich that to process it in the early years, they didn't even use a processing plant. They just shipped the ore directly. The average mine grade was 45 grams per ton gold. The average mine silver grade was north of 2,000 grams per ton silver. So these types of grades are completely unheard of. What started and sparked the interest for Skeena was the fact that the cutoff grade was 15 grams per ton. Our executive chairman, Walter Coles, has always had a saying that the best place to find a new mine is in the shadows and headframes of an old mine. That's exactly what we did. Since 2017, we've been aggressively advancing this asset. We've drilled over 200,000 meters. We've outlined a 4.6 million ounce reserve. We've put out multiple technical reports to increase our confidence and understanding. And now we have production in clear line of sight by 2027, in 2 years' time. But Skeena will be doing it differently. So formally, it was an underground operation, and we will be mining Eskay Creek using open pit methods. We are coming out of the gates with a production profile of 450,000 ounces of gold equivalent metal in years 1 through 5. This is a grade-driven profile. Our average grade is 5.5 grams per ton equivalent in years 1 through 5, which places us as one of the highest grade open pit mines in the world. And when the grade is this good, the economics follow. So we are at the bottom of the industry cost curve in terms of operating costs. And the cash flow is phenomenal. At spot prices today, we will be generating $941 million in after-tax free cash flow per year in years 1 through 5. I want to take a pause and just really appreciate that number, because you don't have to be a mining investor to understand that this is an incredible opportunity. There's a significant silver component. If you like silver, I definitely do. And we closed our landmark financing package last summer. So the project is fully financed to production. The project is located in the Golden Triangle in northwest British Columbia. So if you're unfamiliar with the Golden Triangle, it's an area that's known for immense geological potential. We're headquartered in Vancouver. You take a flight to Terrace for 1 hour, and then you drive up the mountain for 5.5 hours. Within this particular area, there's a number of world-class operations and projects. It's absolutely no coincidence that Teck and Newmont have established operating platforms here. The project is situated on Tahltan territory. That is the indigenous group with whom we're advancing the project. Because there is so much mining activity in this small particular area, the Tahltan Nation considers themselves to be a mining nation. They understand socioeconomic impact, they're a savvy business partner, and we have an incredible relationship with them as we advance this project forward. We're very proud to have the first Section 7 agreement in Canada. What that means is that the Tahltan Nation will be the first Indigenous government in Canada to provide consent to approve this project together with the province of BC. We are currently in the environmental assessment application phase. We submitted our initial application in August of last year. We addressed 2,000 comments. We're filing our revised application in April of this year, and we expect to be fully permitted in Q4 of this year, which will be the next major catalyst for the stock and the next major de-risking event for Skeena. A little bit on the political landscape in British Columbia. In February of this year, the Premier of BC made a public announcement in response to the impositions that the Trump administration launched on Canada with regards to the tariffs. And our Premier said that he would like to expedite 18 projects to offset the negative implications of these tariffs, and Eskay Creek was at the very top of the list. So this is very important because we have bureaucratic support. And this is further evidenced by the fact that we actually received early works authorizations and amendments last summer to proceed with early construction activities last year ahead of final permits. So that when we receive our final permits in Q4, we'll be about 30% complete on the construction schedule. Being a past-producing asset provides a significant amount of benefits for us. The one that I feel is extremely important is that Barrick left behind a fully permitted tailings facility for us that saves us $150 million off the CapEx. The other item is these 3 bolts that you see in the middle. After Barrick placed the mine on care and maintenance, a private company came in and installed 3 hydroelectric facilities 17 kilometers away from the mine. This allows us to source power for 6 cents per kilowatt hour. Other mines in Canada are paying 10 times that price. So if you really want to understand the Skeena advantage or the secret sauce for why we are so profitable, it's quite simple. Ultra high-grade deposit plus low cost of power in an energy-intensive business equals a very profitable operation. So now we're going to get to the fun part. We're going to answer the question that I started my presentation with about why is Skeena the best investment for gold and silver that is available today. Firstly, we have scale. We've got 4.6 million ounces in reserves. Within that 4.6, 80% is in the proven category for an ultra-high rate of confidence. And that size places us in the top 15% of the largest open pits worldwide. We've got grade, and investors always say grade is king, because it's your best line of defense for managing a cyclical business. So 5.5 grams per ton equivalent in years 1 through 5 is triple the global open pit average. If you look at this chart, and you will recognize a number of names. There are many successful open pit operations that are profitable at 1.3 grams per ton, 1.5 grams per ton. So imagine what 5.5 grams per ton does. In late 2023, we put out a definitive feasibility study to encapsulate the inflationary pressures post-COVID. And the results were phenomenal. At spot prices today, we have a net present value of about $5 billion after tax. We've got an IRR of 75%, and our payback period is 0.7 years, meaning that in less than 300 days of operating at full-scale production, we will pay back the initial capital cost of the project. On the other side of production, the financial metrics are even more astounding. At spot prices today, our annual EBITDA will be $1.5 billion. You take that EBITDA and you apply a conservative multiple of 6 times, you get to a healthy market capitalization of $9 billion. You take $941 million in after-tax free cash flow and you apply a multiple of 8 times, you get back to that healthy market capitalization of $9 billion. So that's important to point out because it gives you an idea of where we as management think the valuation of the company will be worth in 2 years' time as we get into cash flow. And the market cap of the company today is $2 billion. The production profile is front-loaded. So you can see that the grade and the ounces dip off in years 5. We're coming out with an updated study on the other side of the environmental assessment certificate where we will backbolt internal growth opportunities into the production profile to smooth out that drop. We have another asset in the portfolio called SNP that contains 9 gram per ton material. It's 40 kilometers away, and we will truck the ore and process it at the Eskay mill. And that study will come out in about 1 year's time. So let's talk silver. The value split is 65% gold and 35% silver. But because of how big this operation is, the 35% byproduct credit on the silver makes this one of the largest primary silver mines from a tier 1 jurisdiction. So in years 1 through 5, we're going to be producing 9.5 million ounces of pure silver versus life of mine of 7.7. And if you know the silver space, you know that's very, very meaningful. It's important to us because we think the fundamentals for silver are very attractive. We see a meaningful byproduct credit on our unit costs that make us more and more accretive. And we also see an opportunity to propel our re-ratings going forward because the silvers command higher multiples. Last summer, we announced a very big step forward in terms of de-risking with a financing package for $1 billion Canadian against a projected initial capex of 713, so we are overfunded. We went with a group called Orion Resource Partners because they were willing to give us a significant amount of capital ahead of final permits. The market loved the deal. It was received very well. And I will explain why. So firstly, the equity component was the smallest part because minimizing dilution is very, very important to us. The gold stream for $200 million US, we will draw down on this year in $50 million tranches to support the construction schedule in 2025. The interesting thing about the gold stream is that there is a buyback provision to buy back 2/3 of the stream at an 18% imputed IRR. That was important to us because it eliminates impediments to an M&A situation should one present itself down the line. The senior secured loan we will draw down on the other side of the permits. The coupon is SOFR plus 7.75. There's a 1% standby fee and no break fee, meaning that between now and drawdown on the debt, if we find a more attractive cost of capital in the marketplace, we will go ahead and replace it. That's actually what we intend to do. The cost contingency is in the same shape and form as the gold stream. But what this package allows us to do is to come to the market and say, hey, We're fully financed for the next 2 years to take this project to production, but we also have optionality and flexibility to continue to improve the deal. This is my favorite slide of the presentation because it really, really solidifies what the investment opportunity is about. We love the Lassonde curve. Rinse and repeat. It works every time if the company executes properly. So the idea is, if you're not familiar with it, this is a standard mining framework. And the idea is that you make a discovery and the stock goes up. Then you put out a feasibility study and the stock goes down. And this blue overlay is actually our stock price. And then you put out your financing, and if the market likes it, now you start climbing the right side of the Lassonde curve, which is the heart of the curve. So when we announced our financing package, we came out of the valleys, but today we're sitting at 0.4 times PNAV. We see a pathway to 1.2 times NAV, conservatively speaking, with the world-class gold and the world-class silver, meaning that the upside opportunity is fourfold from where we are today. The other way to look at it, and it's really simple, is just on industry comps, because there's not a lot of single asset mines that are producing 500,000 ounces. And so the one that we look to for inspiration is Lundin Gold with Fruta del Norte, because the operating parameters are very similar in terms of production profile, in terms of grade, in terms of cash flow, in terms of reserves. And they're sitting at a very healthy PNAV multiple of 1.6 times NAV and a market cap of nearly $15 billion Canadian. So when we look at all the different methodologies for establishing valuation, we always get back to that at least very conservative $9 billion market capitalization in 2 years' time. And so that's really the opportunity. If all of that wasn't fabulous, then you have to look at our shareholder roster. We are 70% institutionally held, and we have the creme de la creme of mining funds and generalist funds that own the company. Between Helicon and Blackstone, two very successful generalist funds, they own about 18% of the company, and they've been coming in rather recently into the name. We've also got 11 banks on the Canadian side that follow the stock. And to me, the most important thing and the most impressive thing is that we only have 114 million shares out. Because a hard and unforgiving truth that I've learned along the way is that the valuations for a company with 400 million shares or 800 million shares are very different than a valuation for a company with 100 million shares. And equity discipline has been at the heart of our management strategy, particularly now that the project is fully financed. So just in wrap up, just going over the main key points again. So it really is a world-class gold ore body backed by one of the highest grade profiles, significant reserve size, very sizable production, incredible financial metrics. All-in sustaining costs, co-product are $538, but net of the silver credit, they're $300. Cash generation at $941 million at spot prices today. An amazing silver opportunity. It's both a world-class gold and a world-class silver opportunity. And most importantly, the valuation upside is incredible with today's PNAV of 0.4 times and a time horizon to production of only 2 years. I'll leave it at that, and thank you so much.
Thank you.